Welcome back. Now my fuzzy head has cleared from the New Year celebrations. In this video, I wanted to cover a simple set of things that you can do to assess your financial health before we get into the swing of 2025. And to do that, I've created a 5-step process. It takes us all the way from setting our strategy all the way through to tracking the progress of our portfolios as we go forward. This will allow us to get into the right space for 2025 and making sure our portfolio matches our aspirations. As is customary on these things, I've given this a catchy name. START, S-T-A-R-T, starting with strategy as a first step. So let's dig into that. So your investment strategy is the foundation for everything. You really need to know why you're investing in the first place. What's your goals? What's your aims? And this is where an investment policy statement comes in. Now, I've done a video already on this, but we'll quickly touch on the key questions you should, or I consider you should ask yourself as part of setting that investment policy statement or your strategy for why you're investing and what your aims are. So you can find this template linked from the description of the video above. And what it does is takes you through a number of questions. So these are questions I use to set out my strategy when it comes to my investment portfolio. So for instance, you've got questions like, what are your financial goals? What's a time horizon that you're working towards? What's your risk profile when it comes to your investments? It then goes into areas about specific constraints or assumptions you need to take into account when creating your strategy for your investments. You may have particular expenses coming up. There may be a house purchase, there may be a loan repayment, you may have to fund university. These are constraints that need to be taken into account. Certain living expenses, for instance. And then you're looking at if there's any particular philosophy you've got around investments. It may be that you want to invest in ESG stocks only, for instance, or in certain jurisdictions, because you've got a belief that those are the jurisdictions that are going to perform better in the coming months and years. And then how you evaluate and monitor against the performance. And this is where you look at benchmarks to make sure that you're achieving your thresholds and your benchmarks for your investment future. And then we call out any particular actions that you may have to adapt your current portfolio to that strategy that you've identified. Like I say, this is included in the link of the description in the video above. So the investment policy statement is all about creating your strategy, why you're investing, what it is you're investing in, and how you're going to monitor that on an ongoing basis. It's really worth considering, are there any major life events coming up in the coming months and years that you should take into account when considering your strategy? So the next step is T for targets. What are we trying to actually achieve with our investments? We need to be as specific as we possibly can be. Something like saving for retirement is just not really enough when it comes to investing. We need to aim for smart targets, smart time-bound targets and goals. Now, this is where we set our benchmarks for each of the different types of investments we have. So as an example, I distribute my assets into 3 buckets. The first bucket is cash. So what I expect my target for that cash bucket is simply to be above inflation by 1%. So it's a very straightforward measure for all of the assets within that first bucket. Now, that bucket consists of a number of different investments. That is high interest savings accounts, premium bonds, includes money market funds. And if you're interested in how I do this, then there's a video linked above. But essentially what it does, by targeting expectation against those assets, what I do is then seek out the best way to achieve that target on an ongoing basis. Now, I don't look at this regularly, because once they're set, largely it's set and forget for a period of time to make sure that those targets are being achieved. The third step is around allocation. This is how the money is spread across different asset classes like stocks, bonds, real estate. What you're after really is a well-diversified portfolio, as that's important to managing risk. And make sure your allocation's within risk tolerance.
This is tolerable.
And this is all about making sure that your allocation, your diversified portfolio matches with your strategy that you set previously and which you reviewed in step 1. Well, the next step R is about results. So how did your investments actually perform? Look at your returns, compare them to benchmark. You need to be quite conscious here that you don't measure that over too short a time period. But what you were looking at is, did those investments achieve the benchmark that you set as part of your strategy? Did the cash assets, for instance, get above that benchmark of 1% above inflation? One thing to watch out for here, of course, is that you assess the investments over the right time period. Long-term investments like equity investments they shouldn't be assessed on a short-term basis. Sounds self-evident, of course, but I've seen many people react and overreact to dips in the market when actually long-term investments by their nature should be assessed over a 5 to 10 to even 15-year periods. And the final step is T, tracking. Now, there's many ways to track your investments and your portfolio performance. There's apps out there, but I use Google Sheets. It's a simple, flexible way of doing it, and I've created a video as to how you can really start doing that above. Long and short is you don't do it too regularly. You need to keep an eye on how your investments are performing to make sure that they're achieving the benchmarks, but don't look too regularly because this psychologically can be quite impactful, particularly if markets are volatile. Now, certainly looking at your strategy and reviewing your strategy on a yearly or even 6-monthly basis is sensible, but when it comes to your investments themselves, don't go in on a daily or weekly basis to look at them. So there you have it. Start. A simple 5-step process: strategy, targets, allocation, results, track. By following these 5 steps, they've certainly helped me with my portfolio, my approach to investing, and I hope they can do the same for you. I hope they can help you take control of your investments and set yourself up for a good financial year in 2025. I'd be really interested in the comments what your top actions will be within 2025 when it comes to creating a more successful year when it comes to your finances. And as always, if you like this video, please like, and if you haven't already, subscribe and click on the notification bell, and you'll be advised when the next video is released. Have a great day.